Today is February the 28th, 2013. This is Michael Can speaking, and after a brief hiatus, our market comments return. Markets have enjoyed a healthy start to 2013 with the TSX up 2.4%, but weakness in the metals and energy industries have subdued our returns as metals are off 10% year to date, while oil is up only 1.8%. Those figures are noteworthy as many of the global indices are stronger, with the S&P 500 up 6.3%, London up 7.25%, and Japan up just over 8.3%. Canada right now is in the middle of the pack in terms of index returns, and much of that underperformance as a result of those large weightings in the materials and energy indices. As we speak to clients and friends around the investment industry, we realize that many people are feeling beaten up by the markets here, and quite frankly, you're not alone. As you can see on the first chart, this has been the experience of investors in North America over the course of the last 5 years, starting January 2008. The cumulative return of the TSX is minus 8%, while the S&P is up a mere 3%. And consider this, the TSX has been above zero on a cumulative basis 6 months in the last 5 years, while the S&P 500 is for the first time this quarter actually up in the entire time frame in Canadian dollar terms. Frankly, we understand the frustration that everybody is feeling, and we're not immune to feeling the same. It has made some folks wonder why they would ever even invest in equity, but clearly history shows that equity investing has been rewarding. I will discuss this issue more in next week's commentary, but for now, notice that since the middle of 2009, the uptrend, though with some volatility in the United States, has been quite consistently higher, whereas Canada has suffered a little bit of a sideways move over the course of the last nearly 2 years. I'm not sure if this second chart makes us feel better or worse, but if you were a Canadian investor in the S&P 500, your Canadian dollars at this moment in time invested in the S&P 500 would have an underwhelming return of minus 30% since 2000. The TSX, on the other hand, is up 50% since that period, and though that is not a tremendously large compounded return, it nevertheless does indicate how well Canadians have done on a global wealth basis, as our global peers have experienced substantial downturns in their markets. And quite frankly, you add on top of that the positive result that we have had in our real estate, and you realize that Canadians have, relative to their global peers, grown richer since the turn of the millennium. Though, as the chart would clearly indicate, it has been anything but a stable period over that time frame. My discussion in my next commentary will be to indicate that this sort of volatility has not been historically abnormal, though not historically desirable. So, what do we do with this information? It looks as though capital is finding its way back to the market, as $600 billion left the equity markets over the course of late 2008, early 2012, and slowly some markets money started to come back to the market over the course of the last couple of months, to the tune of about $20 billion or so. That is a very positive indicator, for money is the fuel that drives stock prices higher. The market continues, as would indicate by the recent uptrend in both the US and in Canada, to shrug off some of the negative global news of political, financial, and global uncertainty, and that is a positive. We remain constructive on markets here, but do favor investing outside of Canada for the time being until such point in time as we see an upturn in global commodity prices, particularly the oils and golds, if indeed that happens over the coming months. For now, the best prices that we are finding on a global basis are being found in the United States and some of the emerging markets on the dividend equity side, and that is where we are going to focus our attentions at this moment in time. If you feel beat up because of the way markets have treated us over the course of the last 3 years, don't feel like you're alone. Everybody's in the same boat right now, unfortunately. The good news is that equity and company balance sheets are not overpriced. Balance sheets are quite strong, and quite frankly, equity is more favorable than debt at this moment in time from a relative value perspective. And that's where we're focused. So that's it for now. We thank you for listening and wish you and your family best health. Thank you.